Remember the two finance professionals who went to lunch in the last lecture? Well, they live fairly close to each other, and at the end of the day, they typically walk home together, at least for part of the journey. One night, while walking home late, it was dark at that time, they saw a well-dressed guy crawling on his hands and knees next to a car. As they passed, they asked him if they could help, and the guy replied that he was looking for some money that he had dropped earlier. He wasn't sure if he had or hadn't, and if he did, whether he dropped it there or elsewhere. The academic professor suggested that they look under the light across the street. If there was any money to be found, it would be easiest to find it under the light. And if no money was to be found, that would be strong evidence that the guy did not actually drop any money and that he could stop searching. The Wall Streeter resisted and said to the academic in hushed tones that he knew where the money was, but wasn't going to tell so that he could have it all to himself. In the last lecture, we examined the efficient market hypothesis and its implications. In this lecture, we'll examine the body of empirical evidence on whether these implications are actually borne out by the data in actual markets. By examining this evidence, we'll get a sense of where you might want to look for trading opportunities and where you need not bother. But the point of the above story is that the finance academic and the practitioner is that you are in a bit of a quandary. The academics have studied the issue of market efficiency for a long time. Some critics claim that it's hard to trust their conclusions because the academics always look for inefficiency and find little or none by looking at publicly available data, like under the light. Furthermore, most academics are not motivated or compensated by profits, and as a result, they have a muted incentive to find market efficiency. Lastly, if they are motivated by money, which I can attest many are, just like any other person, then if they did find some market inefficiency, they would probably not publish their findings. Finance practitioners, however, are motivated by profits, and in many of them sell their services for managing your money, the service of finding money for you, and they sell that for a fee. Thus, they have every incentive to claim that they, of course, know where there's market inefficiency, and that they are the only ones that can find it. The bottom line is that while most of the academic evidence in the markets are that the markets are fairly efficient, even the academics have found a number of phenomena that seem to put chinks in the armor of the efficient market hypothesis. This lecture will look at some of the most notable phenomena. I should warn you, however, that some academics are not convinced that these phenomena constitute excessive profit opportunities. Rather, they view them as anomalies with respect to some of our simple models and continue to entertain the possibility that the models are flawed and sometimes indicate false opportunities. We'll discuss this view in the lecture too. It'll be up to you to decide and potentially act on which view you find most compelling. As we discuss each phenomenon, I hope you will get a sense that each phenomenon is fairly involved. The fact that these are the phenomena that keep cropping up in discussions is evidence that markets are fairly efficient. If they were wildly inefficient, then there would not be much debate about these potential few phenomena. Okay, so the first set of anomalies we'll discuss concern predictable patterns in returns. These might be violations of the weak form of the efficient market hypothesis, in that presumably you can make excess profits simply by executing trade strategies conditional on past returns or price levels. There are a few of these phenomena, but let me start with the momentum phenomenon. To understand what this phenomenon is, consider the following strategy. Step 1 is take a list of many securities, say those traded on the NYSE and the NASDAQ, and calculate the returns over some past period. For example, calculate their returns over the past 6 months. Step 2 is to rank these securities from highest return to lowest return. And then step 3 is to buy all of the securities in the top 10%, let's call them winners, and sell short all the securities in the bottom 10%, let's call them losers. The final step is to hold this portfolio for 6 months. Then after 6 months, do it again. That is, re-rank all the securities on the NYSE and the NASDAQ on the basis of the past return in the last 6 months. And then go long those securities in the winner 10% and short those in the loser 10%. Hold for another 6 months, and then repeat. It's been shown that, on average, the returns from this strategy dominate the returns from a passive strategy of just holding a market portfolio, consisting of all of the securities on the original list. It has also been shown that such phenomena exist if you use different horizons, say only go back a few months, and only hold the portfolio for a month before rebalancing. Furthermore, the magnitude of the extra return is fairly large. If you rebalance once a month, you can get about 1% extra return, which when compounded over 12 months is approximately 12% per year. And that's significant. According to the weak form of the efficient market hypothesis, you should not be able to beat the market by trading on the basis of past returns. But this momentum strategy, as the name suggests, indicates that stocks go up and they continue to go up. And the stocks that go down continue to go down. There's some sort of momentum. This is a predictable pattern that is not supposed to happen if markets are weak form efficient. Okay, so let's think of some explanations here. There are many retorts to the conclusion that this appears to be inefficiency. Let's examine each of these retorts in turn. One retort is that it fails to consider transaction costs. Such a strategy is costly to implement, especially for a small investor. If you consider all the stocks in the NYSE and in the NASDAQ, we're talking thousands and thousands of stock, around 7,000 in total. If you do the rebalancing each month, say, it turns out that many of the stocks that were in the winner portfolio over one period are not in the winner portfolio the next period. So too, it's true with the loser stocks as well. So to implement this strategy, you have to trade a lot of stocks in each period. And if you have to pay a brokerage fee, such fees are going to eat up any gain that you had. In addition, if financial institutions seek to exploit this phenomenon, even though they have much lower transaction costs, they don't have to pay a broker, it turns out most of the stocks in the winner and loser portfolios are stocks that are what are called thinly traded. Thinly traded stocks are those with little volume, and when people trade even small quantities, they move the price significantly. What this implies is when you go to sell your winners after holding them, you will push the price down, reducing their return. And when the academics study these phenomenon, they don't do so by actually trading, rather they just look at the prices that occurred in the market. For the thinly traded stocks, the data does not reflect the cost of an actual trade that would be made. Thus, the returns on paper look much larger than they would be if you actually tried to implement this strategy for real. A second retort to momentum being evidence of inefficiency is that the excess return from the momentum strategy is really not excessive. Rather, it is a fair return, a fair compensation for risk. While the momentum strategy is seemingly innocuous in terms of risk, the retort claims that it actually has you load up on risk. The argument is that the mechanics of the strategy results in a selection of a risky portfolio. Okay, so let's see why. The idea starts from the position that over 6 months, the mean returns on securities are not negligible. Unlike at the daily level, where we ignored mean returns, like in last lecture, a 6-month return may be big enough that variation in mean returns across stocks may matter. If markets are efficient, then those securities that have more risk should have higher returns than those that have less risk. What will you get when you sort stocks on the basis of their past return? Although the label of winners for the top 10% of securities indicates a set of securities that have won, perhaps there's just a bunch of securities that have a bunch of risk. The reason they are in the winner portfolio is because due to their higher average return, due to their higher risk, they have gone up more on average. They would have gone higher anyway. This is similar to the following situation. Consider a set of 100 people. All are men from age 20 to 29. This set of people was randomly selected. 50 men were chosen at random from Bolivia, while 50 men were chosen at random from the United States. We then measure each person's height and rank them from highest to lowest. We then look at the top 10 and the bottom 10. What fraction of the top 10 do you expect will be from the U.S.? What fraction from Bolivia? And for the bottom 10%, what fraction will be from the US? What fraction from Bolivia? What if the average height of men aged 20 to 29 in the US is 5 foot 9 inches, but the average height of men aged 20 to 29 in Bolivia is only 5 foot 3 inches? Given that, it probably would not be surprising that there will be more men in the top 10 group that are from the United States and more men from Bolivia in the bottom 10 group. Similarly, it might not be surprising that the top 10% returning securities overrepresented or oversampled from riskier securities, which have higher returns on average. What about the bottom 10% returning securities? They may simply be securities that are not very risky on average. Thus, their average return is relatively small. So what happens when you hold a portfolio that is long risky assets, you buy them, and short low risk securities? That portfolio has more risk than the average amount of risk. This is true because the strategy has you take a long position in risky ones and a short position in low risk ones. If you take a long position in each, say splitting your money equally between the winners and losers, then that group will have an average amount of risk. But the momentum strategy has you buy very risky securities by essentially borrowing the money by shorting low risk securities. This is a very, very risky strategy. So the argument is that since the risk of this strategy is riskier than holding the market, then this strategy will generate higher returns than the market on average. As we'll discuss later after we examine some asset pricing models, it is kind of hard to confirm or dispute the possibility that momentum returns are just compensation for risk. And that's because it is really hard to measure risk. If we had a sure way to measure risk, then we could test this possibility. Specifically, we could see if the winner portfolio is actually riskier than the loser portfolio. Researchers have examined this using a set of standard asset pricing models to define risk. And they have found that risk explains very little of this extra return. Okay then, must be inefficiency. Not so fast. Note that I was careful to say if we had a sure way to measure risk. What if researchers can identify a bunch of risks, but not all of them? Then it is still possible that the winner portfolio consists of more securities with unknown hard-to-measure risks than the loser portfolio does. If so, then the extra return is simply compensation for investors bearing these hard-to-identify risks. Of course, this extra risk has to be risk that the investors know is there. This is why they discounted those securities more, but academics and professionals can't measure or quantify. If it's not a hidden risk, then the market might be inefficiently pricing things. One last fact that I want to share with you that might sway you one way or another as to whether this is inefficiency, a profit opportunity, or it's efficiently pricing hard to identify risks. Initially, it seemed that momentum profits were fairly persistent across time and location. Researchers showed that the momentum phenomena occurred over multiple time periods and in both domestic and foreign stock exchanges. However, momentum appears to be less pronounced over the last decade. As we discussed last lecture, if there's a pattern in a return, then we would expect that as investors traded to exploit these patterns, the patterns would moderate or disappear. That seems to be what happened with momentum. A similar phenomenon has occurred with something called the turn of the year effect. It used to be the case that small stocks that did poorly during the prior year would have very sizable returns during the first 5 trading days after the turn of the year. This was a very strong effect occurring year after year. Now it does not happen on average. Okay, let's examine another type of evidence of inefficiency. The evidence concerns the volatility of stock returns. Recall that the efficient market hypothesis says about what generates volatility. The efficient market hypothesis states that the arrival of new, i.e. unanticipated information, will create changes in the value of securities. The changes in prices reflect a change in the state of knowledge about the future. Thus, the variation in price changes must be related to the arrival of information. In addition, if the markets are going to send the signals regarding where to allocate resources, then the information prices should reflect should be only relevant with respect to fundamental value. There are two types of phenomenon that would be very disturbing with respect to the efficient market hypothesis. First, it would be disturbing if the amount of variation in prices or returns was not plausibly related to the arrival of relevant information regarding fundamental value. If markets are too volatile or not volatile enough, both would be bad. If the markets are not volatile enough, then prices clearly do not update frequently or by enough. Then resources will be allocated on the basis of old information. And if markets are too volatile, then clearly the prices are reflecting something irrelevant, letting capital be allocated on the basis of who knows what. A second thing to look at is whether price changes are permanent or temporary. If markets are efficient, then any price change caused by the arrival of new information should be permanent in the sense that it will not be reversed on average. If on average some reaction is reversed, then the markets must be overreacting. One way to examine the appropriateness of volatility is to compare short-run versus long-run volatility. If price changes are permanent, i.e. they're not reversed on average, then the amount of variation in price changes over 2 days should be pretty close to twice that over 1 day. If, however, there is overreaction to some information that arrives that is eventually corrected, then we would expect to see the variance of prices over, say, 10 days to be less than 10 times the variance over a single day. Researchers have compared short-term versus long-term variance and have found, in fact, that the variance of price changes over longer intervals of time, say over 5 years, seem too small relative to the variance of price changes over shorter intervals of time, say over a year, to be consistent with market efficiency. That is, it seems that the amount of variance in the market in the short run is too high. The idea is that in the short run, prices fluctuate too much, either due to investors reacting to things that are not ultimately relevant, or due to overreaction to things that are relevant. Either way, this implies that price deviations from the fundamental values of the security is significant in the short run. Thus, someone who has a strong sense of fundamental value for a security should be able to make an excess return by buying low and selling high relative to the fundamental value. Some very interesting evidence on this excess volatility notion at shorter intervals was discovered while considering differences between trading time versus elapsed time volatility. Studies back in the 1980s compared the variance of returns over two types of intervals. From a market open to a market close, i.e. during the day, and from the market close to the market open, i.e. overnight. While the hours in each interval has changed periodically, the open to close interval is always much shorter than the overnight close to open interval. When researchers compared the open to close variance with the close to open variance, they found what you'd expect, namely that the variance from the open to close was many times larger than the variance from close to open. Even though the close to open period is longer than the open to close period, this comparison makes sense. The amount of information that is produced during the day, especially during the 70s and 80s, the period for which this data came, is much greater than the amount of information that's produced overnight. Thus, we'd expect that the bulk of the variance to happen when the markets are open, when the information is being produced. This is completely consistent with market efficiency. But there's some really interesting evidence that is counter to the efficient market hypothesis that comes from a paper by Ken French and Richard Roll. Their result, which I affectionately call the French roll or the baguette effect, is that the variance of returns of price changes are more related to trading than to the flow of information during normal business hours. Let me explain further. French and Roll study a period in 1968 when the market was closed on Wednesdays. Apparently, there was too much trade volume to keep track of and clear. So they closed the markets on Wednesdays for half the year in 1968 in order to catch up. French and Roll computed the variance of returns from Tuesday close to Thursday close and compared the variance that occurred during the period with Wednesday closures to that which occurred during the period in which the market was open on Wednesdays. They found that the variance of returns between Tuesday close to Thursday close when the market was open on Wednesdays was almost exactly twice that of the variance of the returns between Tuesday close and Thursday close when the market was closed on Wednesdays. Thus, the variance of returns seems to be more related to trading time than to business hour time. This is a bit disturbing in that one would expect that any information that people discovered or was announced on a Wednesday when the market was closed would have been reflected during the trading day on Thursday. Except for the fact that the stock market was closed these Wednesdays were normal business days. As such, the average amount of news regarding non-market related items of relevance to the fundamental value of firms and their securities should have been the same during the period in 68 when the market was open as when it was closed. Thus, the closure, non-closure, Tuesday close to Thursday close returns should have been the same amount given the same flow of news. But when the market was closed on Wednesdays, it's as if that day and its news just dropped off the face of the earth. It's as if the bulk of what generates volatility must be information about market-related phenomenon, not related to fundamental value. The French enroll result has been taken by many as very strong evidence of what Keynes referred to as animal spirits, that the markets mostly reflect information about how people's animal spirits will be reflected in the market. Now that markets are open around the globe, and many securities from one country can be traded in multiple venues, it's hard to make the kinds of comparisons that French enroll did. But what if the effects they document are due to the markets reflecting speculative phenomenon unrelated to fundamental value? Then, especially given that globally markets are open for even more hours in the day, there might even be a greater amount of excess market volatility. All right, let's consider an explanation of this phenomenon. An alternative hypothesis is that the information that gets reflected in prices is actually relevant for fundamental value, but the market itself facilitates aggregating people's potentially disparate views on the implications of that information. That is, the market process itself may serve to come up with a consensus view of the implications of new information. Without the market process that produces prices, it's hard to know what that information means. There's a well-known exercise that gets at this notion. By the way, this exercise is based upon a gentleman who used to travel to English county fairs and ask people to guess the weight of a prize cow. I actually conduct a variant of this experiment in some of my university courses. Prior to class, I fill an empty jar, and this jar used to hold about 32 ounces of rice, with coins. Includes pennies, nickels, dimes, and quarters. I then pass the jar around the class of about 100 people and ask them to guess the number, not the value, but the number of the coins in the jar. I have them write down their guesses on a piece of paper and hand it in to me. To give them the incentive to think about it, I tell them that I will give them extra credit points if their guess is closer to the truth than the average of the guesses. That is, in order to get points, they have to be more accurate than the average. For example, if the actual number of coins is 1,200 and the average is 1,175, to get extra credit, they will have to guess between 1,175 and 1,225. The idea is that the average of the guesses is close to what the market would determine the price to be. The price would be the average of people's beliefs, simply to let supply equal demand. There has to be as many people who want to sell as want to buy. So the average price sort of makes this balance. As it turns out, I very rarely give any extra credit. The average of the wide range of guesses is better than most people's individual guess. Thus, the averaging process of the market may actually produce useful information. If the market does serve this useful purpose of aggregating the value implications of new and relevant information, then that might explain the French roll results. If the market is closed on Wednesday, perhaps it takes longer than the time during Thursday's market for the market to form that consensus. If so, then the drop in volatility is simply because there's less information conveyed by the market, because the market is not open enough time to fully convey that information. This is both good and bad news. It suggests that the market is actually doing something useful. It's not only it's reflecting relevant information, it's also conveying relevant information. That's good. The bad part is that it takes longer than a day for it to do this. In my mind, that's not too bad, but it does indicate that if you have superior idea of fundamental value, then you may have a window of opportunity, at least a day, in which to exploit your superior view. By the way, during the 1968 closure period, the variance of returns per week were only slightly more than 4/5 of the weekly variance when the market was open. So it's not that it took longer than Thursday for the Wednesday information to get reflected in prices. Rather, it appears that the Wednesday information was lost for good. Given these results, it seems that the prices may be wrong for a while. The question then is whether others can effectively exploit this fact. For this, there is a significant body of literature that examines the ability of professional fund managers to beat the market. Professionals spend all day looking for and exploiting market inefficiency. Since they spend a significant amount of time and resources on such activities, they might be able to beat the market. The evidence on this is actually fairly clear. On average, professional fund managers do not beat the market. On average, fund managers underperform their benchmarks. That is, they have a particular set of securities they're trying to outperform, but they're unsuccessful on average. Of course, this is just an average result. There are clearly fund managers who do beat the market in any given year. The question is whether this is skill or luck. If it were skill, then we expect good managers to be able to outperform many other managers in other periods as well. The empirical evidence on persistence is that most managers that outperform the market do not have much, if any, persistence in their superior performance over time. In fact, the only category that has persistent performance is the category of very poorly performing managers. It's actually surprising they'd survive given their extreme poor performance. That they do survive should tell you to be careful when picking a professional manager. Bad managers are out there. Among the set of managers that do outperform, there's a small set that have outperformed over many periods. On these managers, I have 3 comments. First, in many cases, their persistent outperformance is due to their carrying over returns from previous years. What you want to do is look at whether most of the manager's long-term return is from 1 or 2 years only. I have seen studies that show that many managers that have very good performance typically shift into very low-risk strategies thereafter in order to be able to protect their past performance. They do this so that they can claim persistent performance, when in fact, it's just luck in one period. My second point is, even if managers do have superior performance over multiple periods, that fact is only weak evidence of superior skill and ability. To see this, consider another experiment I always conduct in one of my university courses. In the course, I ask students to see if they have any telepathic ability. To see if they do, I have them flip a coin 6 times in a row and keep track of whether it's heads or tails on each flip. I ask them to concentrate and try to get the coin to come up heads. After they flip, I ask everyone, was there anyone that got 6 heads in a row? In a typical class size of 70, it almost always happens that at least one person gets 6 heads in a row. If they were managing a portfolio and they beat the market 6 years in a row, they would be worshipped as an investing god. But clearly the person who gets 6 heads in a row is just lucky. Yet the likelihood that we would get one lucky person out of 70 is actually fairly high. In contrast, if I were to single out someone beforehand, then the probability that that person would get 6 heads in a row is extremely low. In fact, it is 0.5 raised to the 6th power, which equals about 1.56%. However, the probability that out of 70 people, there will be at least one person who gets 6 heads in a row is surprisingly close to 1. In fact, in all the years I've done this experiment in class, I've never failed to get at least 5 or 6 heads in a row. This is very similar to the answer to the question, what's the probability that out of n people, 2 have the same birthday? The answer is a surprising 99% for n around 60. Similarly, out of thousands and thousands of professional fund managers, it's not surprising that we can find a few managers who beat the market over many periods. The third thing I want to say is in most cases, the people that have superior performance charge higher fees. In these cases, the after-fee returns that you will get will likely not beat the market. So even if there is some market inefficiencies that some people with superior skill can exploit, the market for their services does not seem to be inefficient. In this lecture, we have seen some conflicting evidence regarding market efficiency. In my mind, this evidence is whether individuals can make excess returns on average. It's clear that, on average, they cannot. But that doesn't mean that there aren't some people who can't. Perhaps you're one of those people. But since most people are overconfident, again, I want to suggest that you make sure you evaluate your performance systematically. And for that, you need to know how to account for risk. And that we're going to do shortly.